Hey guys, welcome to Market Mondays. Hopefully, you guys had a great weekend and we'll have a lot to look forward to this week. So, give you guys a quick breakdown of what happened last week and going into this week. Before I get right into it, I'm gonna do a quick dad joke. Dad joke today is what kind of key opens a banana? What kind of key opens a banana? A monkey. Get it? Monkey. Pew pew. All right. So getting right into it. Last week, it wasn't a whole lot of news in terms of what's going on with the Iran and US deal in terms of what we've been used to. For the most part, things are pretty much the same as they ended last weekend. Now there was talks about Israel and Iran trading attacks, but apparently they stopped, and the president has stepped in and asked them to stop attacking each other. And of course, we're still on the verge of signing a peace deal. So, which in hopes will open the Strait of Hormuz, get the oil flowing again so we don't see higher oil prices. And with oil prices coming down and the conflict being resolved, we will probably see mortgage rates improve at the same time. So everyone's just waiting for that. I think the markets are getting tired of this whole, who cried wolf kind of situation. So we hope that, we start seeing more and more progress toward that direction as best we can. But one of the big news that came out last week was the labor market news. And what's tough about the labor market was that it is improving, which unfortunately made mortgage rates a little worse. So right now the unemployment rate has stayed at 4.3%, but there have been one thing that was really a big deal was the economy saw about 172,000 jobs being added when the expectation was only 85. And this was also very true in the private payroll sector, where they saw higher levels of employment as well. So right now, nothing has changed with the unemployment rate. It stayed the same, but overall, the details showed that the labor market is strong. It is improving from where it has been. So that's a relatively good sign for the labor market. Not so much for the mortgage market, because mortgage rates did get a little worse on the day this information came out. So to give you guys a bit of a scope of how everything looks right now, we have seen rising mortgage rates basically since end of February going into March, since this conflict started. Now for the labor market improving, I mean, that's, things happen. We've seen the labor market continually get worse for the past year and a half. We finally see it start improving, and maybe that is expected to come. So we'll see how the next 2 months go. But for the sake of mortgage rates, I mean, we did from Friday, it did pop up because of the labor market news. If this whole peace deal gets signed this week, which they're saying it's on the president's desk to sign, we could see the Strait of Hormuz open and mortgage rates come down along with oil prices. Otherwise, that's really the main news I got for you guys that week. There's really not much else to talk about, but there is one thing I do want to show you guys that I kind of ran numbers on a while back. It had to do with how home prices have been and how much they have changed. So to give you guys a snapshot, I have to bring up the slides for that. Let me get that 1 second, and there we go. But yeah, basically I ran some numbers in terms of how home price appreciation has changed from over just the last 8 years. And it's been very interesting information in terms of how much it has changed. So in terms of equity, if you kind of see the chart here, you can see that every year since 2018 we've seen a positive appreciation. And a little fun fact here is that the last time we saw negative appreciation was between 2008 and 2012, and they weren't that big. It wasn't as big as it was maybe negative 2 or 3%, which is what was expected with the housing market crash in 2008. And after 2012, everything started to bounce back and we saw actual positive appreciation. But the reason why I show this is because every year, and just to give you guys an idea, I started in the lending business in 2017. Without fail, every year since then, everyone has talked about waiting for home prices to come down. Every year since 2017, basically almost 10 years now. And And I just ran some. I got these appreciation data from FHFA. Basically, they get data and they look at the national levels of appreciation. So this is not numbers I made up. And I looked at it. What would happen if you bought a house in 2017 for $400,000? What would it be worth today? And in 2025, it would be worth around 600, over 660 basically. So that's $266,000 of appreciation. That's well more than 50%, right? Return on the value of the asset, specifically the value of the asset, not so much the value of your money, because that's even more. So, and of course, I ran it if you got a VA loan for $400,000. So if you had a mortgage balance and you had home appreciation, how much equity would you have over time? And one of the things I do want to point out is that 2021's level of appreciation as well as 2022 were just astronomically high. And the reason why I even got that high was because how mortgage rates were at that time. And now mortgage rates, funny enough, were at their best probably at the end of 2020. And then they started to rise in 2021. So it took people a while to realize mortgage rates were low and got to the point where everyone could buy a house. And then that's when the market flooded with a bunch of buyers, which caused people to bid more for homes just to get a house. That's what happened with these levels of appreciation, which are astronomical and unsustainable. It's great as a homeowner. It's terrible as a home buyer. 3 to 5% is really good for every year if we can maintain that, because wages have a better chance of keeping up with the home prices going up. So that's what we're dealing with right now, is that it's good that we're seeing lower levels of appreciation in the last couple of years, because home prices skyrocketed in a matter of 2 years, right? The 11% on a $500,000 house is just crazy numbers. That is just, again, unsustainable. It's not something that we want in real estate. We just want steady appreciation. Even if you notice between 2017 and 18, 3 to 5%, it's pretty average, and that's still a decent amount of appreciation. So if you, let's say in Washington State, you spent $12,000 on closing costs, by 2020 you sold the house, you're making $72,000, which isn't bad after 3 or 4 years. So I want to kind of give everyone a sense of where the real estate market is at. The home prices have nothing to do with what the government, well, sort of, but for the most part, home prices are driven by buyers. And why home prices are so high is because of buyers and what the levels of appreciation did back in 2021 and 22. Again, the appreciations are improvements on price from the previous year, so it compounds on top of itself. So it's 4.15% of already after 5.7% appreciation. So it's 4.15% of 422,800 in this case. So keep that in mind. That's the power of real estate, is that the appreciation is on the value of the asset, not so much of the whole idea of renting is cheaper than, or sorry, buying a house is cheaper than renting. That's not necessarily true anymore, but the power of equity is still there. And so if you can afford to buy a house and it's so well within reason, it's the levels of appreciation that you're going to get after 3, 4, 5 years, maybe 6 years of owning the house, and with mortgage balance coming down when you pay your mortgage and appreciation going up, you're going to get more in appreciation than you will from the mortgage pay down. But that just gives you an idea of why real estate is still one of the best performing assets long term. So anyway, that's all I got for you guys. Hopefully that made sense. Nuke out.